I think that we think there's going to be a little bit of a surprise. We said that this year. Everybody thought that interest rates would increase this year. We said we didn't think it could happen, and it turned out that it hasn't. And I think next year, again, we think that people are being too aggressive about their expectation of interest rate increases. We think it's going to take much, much longer, and it's going to be more gradual. We think, the fact that we have all these problems in the world that aren't being fixed, the debt levels are still so high. I don't believe that the Fed are brave enough to go and increase interest rates in that kind of environment. So I think all the expectations are probably too aggressive, which means that U.S. sovereign bonds could actually be, they could be okay for 2015. In that kind of environment, keeping interest rates lower, somehow forcing them low, is probably more likely to support the bond market, and it's going to provide some support to the equity market. So we think these are the kind of policies that the Fed are going to be doing to try to keep this rally for bonds and for equities actually going a little bit longer. We think eventually it's impossible, but we think 2015, that's what they're going to try.
So you think
for sure.
U.S. economy is still fragile?
Very fragile, very fragile, and that's why we don't see the rate. Partly it's temporary, but also we think it's misleading. We think it's a little bit wrong. We don't look at the unemployment number. We actually tend to look at the employment number, which is different. And if you look at the number of people that have full-time jobs, that's actually very, very weak. So a lot of the improvement that's happened in unemployment data is because some people have taken part-time jobs, or it's because some people have stopped looking for jobs. They left the labor market altogether, and so that doesn't help. That doesn't create any GDP. That doesn't create any economic activity. So we think it's much more important to focus on number of people that have jobs. And there's a measure called the employment participation rate, and it's how many people who are of a working age are actually have jobs at the moment, and that is at its lowest level for many, many years. So we think the fact that the employment rate is so low is actually a really worrying sign, and that's what people should be looking at. So actually we think we don't see any signs of recovery in America. We think it's very fragile, and we think the real economy is still hurting very, very badly.
Still fragile. Right?
Still very fragile.
What about confidence in the economy?
I think there's confidence in the stock market. I don't think there's confidence in the economy, and I think that's really this divergence that we're talking about. So I think the stock market has been supported by all of these economic policies, all of these stimulus. That's driven up the stock market.
But
Same
it's
in
not
Japan,
real, right?
But it's not real. It's not really moving the real economy. It's not helping people get jobs. It's not helping people get back into work. It's not. If we look at if we look at lending, that's not happening. The only real lending that we're seeing is on the corporate side. There are two forms of loan growth in the US right now. One is on the corporate side, where companies are borrowing money because the rates are so low and they're buying back their own stock. That doesn't do anything productive. It doesn't help the economy. It just pushes the stock price higher. The other form of lending that's really increasing in the US right now is student loans. So people are still borrowing a lot of money to go to college, but again, that's maybe helpful for them in the long term. In the short term, it's not productive. It doesn't do anything to put money back into the economy. So the kind of immediately productive borrowing, like people buying new houses, buying new cars, that's really not happening at all.